Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourself, Banking and General Knowledge, etc. The next promotion is not just a step up in your career, it's a step closer to your dreams, your respect, and your financial growth. The bank promotion exams 2025-2026 is a golden opportunity, and I'm here to make sure you grab it with both hands. In this journey, we will learn smart strategies, master important topics, and tackle questions just like the exam demands. Remember, success doesn't come to those who wait, it comes to those who prepare. So let's start today, prepare smartly, and make your promotion in 2025-2026 a reality. Welcome to part 12 of my Part to the Corner Office 2025-2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about case studies and group discussions to help you climb the career ladder faster. We're going to discuss case studies for today's session. The previous case studies videos links are available in the description. The first case study for today is eligibility and loan limit. Scenario: Sri Rajendra Singh, a small and marginal farmer (SMF) from a notified SC category, approaches your branch. He has stored 50 quintals of wheat in a WDRA registered warehouse and holds an ENWR. He seeks a loan against this NWR. The value of the pledged stock is rupees 5 lakhs. Question: Is Sri Singh eligible for a loan under the CGS NPF? If yes, what is the maximum loan amount your branch can sanction? And what will be the applicable guarantee cover percentage? Solution: Eligibility. Yes, Sri Rajendra Singh is eligible. The scheme explicitly includes small and marginal farmers (SMFs) and farmers from SC categories. Maximum loan amount: as an agricultural loan under priority sector lending, the maximum sanction limit is rupees 75 lakhs. His stock value is rupees 5 lakhs, so the loan can be sanctioned up to the value of the security, which is within the overall limit. Guarantee cover: for an SMF or SC farmer with a loan above rupees 3 lakhs and up to rupees 75 lakhs, the guarantee cover is 80% of the amount in default. The next key study is interest rate capping. Scenario: A trader, Ms. Gupta Enterprises, seeks a loan of rupees 1.5 crores against an NWR for soya beans. Your bank's 6 months MCLR is 8.5%. Question: Calculate the maximum interest rate you can charge under the CGS NPF scheme. Would your answer be different if the applicant was a farmer producer organization (FPO)? Solution: For trader, non-farmer, the interest rate for scheduled banks is capped at a maximum of 3% per annum over the 6-month MCLR. Maximum interest rate is equals to MCLR plus 3% equal to 8.5% plus 3% is equals to 11.5% per annum. For an FPO, FPOs are classified under Others, Annexure 1B Q3, but they are still eligible borrowers. The interest rate cap remains the same for scheduled banks. Therefore, the maximum rate would still be 11.5% per annum. The key difference would be in the guarantee fee and the guarantee cover percentage. The next case study is guarantee fee calculation. Scenario: Your branch has two accounts under CGS and PF. First is account of a female farmer with an average monthly outstanding of rupees 4 lakhs. The next one is account of a trader with an average monthly outstanding of rupees 20 lakhs. Question: Calculate the monthly guarantee fee payable to NCGTC for each account for the month of July 2025. Solution: Guarantee fee for farmers 0.4% per annum. Monthly fee equals to average outstanding into annual rate by 12 is equals to rupees 4 lakhs into 0.4 percentage by 12, which is equal to rupees 1600 by 12 equal to rupees 133.33. Guarantee fee for non-farmer trader 1% per annum. Monthly fee equals to rupees 20 lakhs into 1% by 12 equals to rupees 20,000 by 12, which is equal to rupees 1666.67. The next case study is account opening and system process. Scenario: A branch sanctions a loan of rupees 10 lakhs to a farmer under the ENWR scheme after 3rd July 2025. Question: List the critical steps the branch must take from the point of sanction to ensure the account is correctly covered under CGS NPF. Solution. Sanction letter. Include a clause stating the account is secured by CGS, NPF and the fee will be charged to the borrower. Account opening. While opening the loan account, the branch must invariably select correct guarantee cover code. Monthly reporting. Report the new account to the zonal office, ZO, by the second of the subsequent month using the prescribed format. Fee recovery. Once the HO provides the account-wise fee details, debit the borrower's account via the correct financial menu to recover the guarantee fee. Case study. A pre-closure of the account scenario. A borrower, a large farmer, approaches the branch to pre-close his ENWR loan account on 15th August 2025. The last guarantee fee was debited in July 2025. Question. What specific action must the branch take before closing the account as per the SOP? Solution. Before closing the account, the branch must ensure that the monthly CGS NPF guarantee fee for August 2025 has been debited to the borrower's account. If not, the branch must first recover the fee for August, the month of closure, and then proceed with the closure. The guarantee fee is non-refundable in case of pre-closure. Next case study is invocation of guarantee conditions. Scenario. A loan amount of an MSME borrower with a sanction limit of rupees 1 crore under CGS NPF turns into an NPA on 1st October 2025. The branch recalled the loan and initiated recovery proceedings in the Debt Recovery Tribunal DRT on 15 November 2025. Question. From which date can the branch invoke the guarantee? List the conditions that must be satisfied for invocation. Solution. The branch can invoke the guarantee after a minimum of 90 days from the date of default, 1st October 2025, that is from or after 29th December 2025. Conditions for invocation. A. The account is classified as a default or NPA by the bank. B. The guarantee is in force at the time of default. C. The locking period of 1 month from the guarantee start date has lapsed. D. The credit facility has been recalled. E. Recovery proceedings have been initiated as per the bank's board approved policy. Example, filing in DRT. F. The bank has taken all necessary precautions, including attempting to dispose of the pledged stock. The next case study is claim settlement process scenario. The bank lodges an interim claim for a defaulted loan of rupees 50 lakhs. SMF borrower with NCGTC. The amount in default is rupees 45 lakhs. Question A. What percentage of the claim will be settled in the first installment? B. If the bank recovers rupees 10 lakhs from the sale of pledged stock after the first installment is settled but before the final claim, what is its obligation to NCGTC? Solution. First installment. For a claim up to rupees 75 lakhs, the first installment is 75% of the eligible claim. Eligible claim equal to 80% of amount in default. For SMF loan greater than rupees 3 lakhs is equals to 80% of rupees 45 lakhs is equal to rupees 36 lakhs. First installment is equal to 75% of rupees 36 lakhs, which is rupees 27 lakhs. Recovery obligation. Any recovery made after the release of the first claim must be shared with the trust. The bank must adjust legal costs incurred for the recovery first. The proportionate share of the trust, 25% of the recovery in this case, as it's the second installment portion of for a loan below rupees 75 lakhs, must be passed on to NCGTC. This must be reported quarterly within 30 days of the quarter end using prescribed format. The next case study is non-eligibility of credit facility scenario. A borrower wants to take a loan against an ENWR for stored up apples. He already has a crop insurance policy that covers the value of the stored commodity against damage. Question. Is this loan eligible for coverage under CGS NPF? Justify your answer based on the scheme guidelines. Solution. No, the loan may not be eligible. According to a clause of the guidelines, the guarantee cover is not available for the credit facility in respect of which risks are additionally covered under any scheme operated or administered by any general insurer. Since the stored goods are already insured, there is a double coverage for the risk, which makes it ineligible under CGS NPF. The branch must seek clarification from HO NCGTC before sanctioning the loan under the scheme. The next case study is warehouseman risk Scenario: a bank suffers a loss on an ENWR loan because the warehouseman issued a receipt for a higher quantity of pulses than was actually stored. Fraudulent issuance. The borrower and the warehouseman were in convenience, but the bank was not involved. Question: is this loss covered under the warehouseman risk component of CGS NPF? Solution: yes, the loss is covered. The guidelines define warehouseman risk to include misappropriation of goods and loss on account of quality and quantity. It explicitly states that the risk includes convenience of warehouseman and borrower. Since the bank was not inconvenience, loss due to the warehouseman's fraud is covered under the scheme. The next case study is final claim lodgement scenario. A loan account of rupees 1.8 crores trader borrower became an NPA. The interim claim was lodged and settled. The bank obtained a decree from the DRT but could not conclude recovery proceedings even after 18 months. Question: what is the prerequisite for lodging the final claim? What additional document is required for this account? Solution: prerequisite for final claim. The final claim can be lodged upon the conclusion of recovery proceedings or after 1 year of obtaining the decree, whichever is earlier. In this case, since 1 year has passed since the decree was obtained, the bank is eligible to lodge the final claim. Additional document: for filing claims up to rupees 75 lakhs, an audit of the claim by a statutory auditor is mandatory. The bank must submit the statutory auditor certificate along with the final claim. The next case study is borrower declaration scenario. While processing a new ENWR loan application, the borrower is reluctant to sign the undertaking cum declaration, arguing that the loan agreement should be sufficient. Question: as the branch manager, how could you convince the borrower to sign the undertaking? What are the key points you would highlight? Solution: I would explain to the borrower that a. Mandatory for scheme. This undertaking is a mandatory requirement for NCGTC to avail of the credit guarantee benefit. B. Benefit for borrower. The scheme provides a guarantee to the bank which facilitates the approval of the loan itself. It's a beneficial scheme launched by the Government of India. C. Key clauses. The undertaking simply confirms their agreement to pay the guarantee fee which will be debited by the bank, acknowledge that the fee is non-refundable, authorize the bank to debit the fee from their account. Without this signed undertaking, the loan cannot be covered under CGS NPF, which is the compulsory requirement for all new ENWR loans. Next case study is monitoring and reporting scenario. The zonal office notices the several branches are not submitting the monthly report for existing CGS NPF accounts by the second of the month. Question: what are the potential consequences of this delay for the bank? Why does the circular specify as the final deadline for the consolidated data to reach HO? Solution: consequences of delay. The bank may fail to upload the data to NCGDC portal on time. This could lead to non-payment or delayed payment of guarantee fees to NCGDC. Delayed fee payment may result in the guarantee cover becoming invalid, putting the bank's exposure at risk. NCGDC may impose penal interest for late payment of fees. Final deadline. The circular specifies that zonal office must submit the consolidated data to the head office BU Rural Department by the 4th of every month. Thank you very much for your patience. Please to like, share and subscribe to this YouTube channel.